Mike Bonds, you are Associate Director, European Research at Savills. Thank you for joining us on BiTV.
Thanks, Luc Etienne. Great to be here.
The recently published Savills EME Investor Sentiment Survey revealed that 76% of investors expect higher refinancing rates to significantly impact their total returns over the next 2 years, and also that 55% of them are adopting a more defensive strategy over the next 12 months. How do you see these trends impacting the European commercial real estate investment activity in the coming year?
Yeah, so I think obviously we've seen over the last 12 months the all-in debt costs significantly rise for European real estate investors, and obviously this is reducing their cash-on-cash returns. Just 12 months ago we were seeing all-in debt costs across some of the German markets at just over 1%. That's now risen to over 4%. That's around 4.5% now. So of course with prime office yields at around 3%, this is minimizing and meaning that debt costs now outweigh those prime yields. What does that mean? We've obviously seen a bit of a reduction in the value of the euro against other currencies. I think US investors certainly will be a little more active with the currency play next year, along with some Singaporean investors. We have seen a reduction in office transactions in the third quarter of this year, down by around a quarter. But I think there's good opportunities out there for those perhaps value-add investors as well, who are looking to turn secondary into prime for those that have cash available still.
Interesting. As more than half of investors reported stable dry powder inflows over the next year, many will still need to be active on the investment front. What asset classes could they target the most, and which ones could they pass up the most, do you think?
I think in terms of sectors, we just launched our EME Investor Sentiment Survey. That shows big box logistics, urban logistics, still top of the investors' wish list. And again, these are the same structural drivers that we're seeing that we just saw 12 months ago. The rising e-commerce, supply chain issues that we're seeing in terms of supply chain bottlenecks, and this is all creating more demand for logistics space. And even though we may begin to see a little bit of a weaker consumer environment, I think the long-term drivers are still there. I think multifamily, again, we see there's an undersupply. The population growth, the shift towards renting are going to be the drivers supporting the market. And again, CBD offices, those investors looking for well-located, good infrastructure links, and certainly occupiers as well, increasing up the green agenda and looking for the best office space in order to encourage their staff back to the workplace.
Okay. I have also to ask from a geographic point of view, obviously not every market are facing inflation, energy crisis the same way. Which markets could show maybe the most resilience during the tumultuous period ahead?
Yeah, I think some of the Nordic cities look quite attractive at the moment. Some of the strongest office-based employment growth that we're seeing across Europe. And again, perhaps more resilient to the energy struggles that you just mentioned. Again, Southern Europe as well, perhaps some late cycle post-COVID growth that we're seeing as we see a recovery in the leisure sector and tourism. And again, I think France, perhaps we're seeing lower inflation across some of the French cities. So perhaps some of the secondary French cities, Lyon, Marseille, where maybe higher yields are on offer for investors, perhaps more resilient to that interest rate rise, and we'll begin to see some rental growth emerge over the next few months and into 2023.
Thank you very much. Obviously, a lot of monitoring to come in the in the coming months. In the meantime, thank you very much, Mike Bonds, for your time, for your insight. Thank you all for joining us, and see you soon on BiTV.